Cool kids doing the stuff that you do. Welcome to the room, guys. Always excited to be here. Hope you are too. It's an educational room. Did you guys know that? We are here to get just a little bit smarter than we were yesterday, but not as smart as we will be tomorrow. That's my goal. There's this Japanese philosophy called Kaizen. And it just says, hey, get 1% better every day. Stop putting the pressure on yourself to be a rock star before you ever pick up a guitar. So what we're going to do today is we're going to take a pretty basic approach, guys. If you're new with me, there's our life for the first 2 or 3 days. If you're new with me, pay attention to the names of things as we go through the indicators, as we talk about what a trigger line is in an area. Get that really basic foundation. Learn the language. And then what we do actually becomes pretty easy. This is an absolute mess on day one, right? Well, here's the cool thing. Let me tell you, kids. We're going to learn to read those charts. You're going to learn to read those charts. I actually, very conveniently, already know how. And we do this for a reason. Why isn't Mark telling me I'm going to get rich? Why isn't Mark talking about the money you can make with the software? Because, guys, the money is just a byproduct of learning the process that creates it. Trading is not about hoping you win or your desire for nice things or trying to impress that girl up the block with your shiny new bicycle. Guys, it's just advantages. It's trading patterns. It's doing the same thing. And really solid trading is boring. Oh my gosh. 90% of your day, if you're doing it right, 90% of your day is doing nothing. 90% of your day is waiting for advantages. This classroom is going to teach you to recognize those advantages. And then 10% of your day is actively trading when you turn those advantages into a trade. Can I tell wifey that? I could. I could. Wives don't believe me for whatever reason. Guys, you're going to understand through your chart reading, through a very basic foundation, a very simple approach to mastering the software, you're going to understand where the market is likely to continue. The likely to continue spots, guys. I've been drawing this picture every day. I hope it makes sense to you guys. The market trends, right? Hey, what's up, Papa Giorgio? The market trends and it goes, and you're like, oh my gosh, look at that market go up. And then it just seems to go down for a little bit. And then very often they continue up. My whole class is going to teach you to define that trend, to be patient, to wait for the fight, and then even more importantly, to use that fight spot where it's most likely to fail for an entry and continue with the trend. If you had to have a summary of what this class is about, it is recognizing that spot right there. That's it. Waiting for the fight. That's the likely to continue, that spot where it's likely to continue with the trend. And then you're going to use concepts like zones and areas. And you're going to be able to say, wow, with these advantages in place, that's where the market's most likely to go. And then here's the brilliant part. And guys, I want you to just be impressed with yourself. You're going to be able to say, that line could stop the market the same way that one did, and that one did, and that one did, and that one did, and that one did. And you're going to know exactly where the market is likely to stop. And then you are going to exercise your right to not take trades into those areas. Those are called termination conditions because they can terminate a trend. Now, there is a step-by-step path to becoming a confident trader. I'm going to share it with you right now, guys. It starts with learning the rules. I give you a plan that only has 3 rules for the first trade. That's it. I'm just not smart enough to make it more complicated. 3 rules on only 2 charts is what we're going to focus on for an entire hour, recognizing the advantages that the software provides. So you're going to learn the rules for when it's okay to trade. Now, this is kind of like, okay, when is it okay to trade? It's okay to trade when your rules are met. These rules give advantages. These advantages, they just describe a pattern. It's a pattern that's repeatable, it's a pattern that's testable, and it's a pattern that when you follow the rules typically wins 70 to 80% of the time. So what we're trying to do is create confidence through the memory of success for the brand new users. And for those of you that have gone a little wayward, gotten away from simplicity, maybe we're trying to regain that confidence. Um, so learn those rules. Don't search for the money. Search for the advantages. The advantages turn into it. Simulate. Practice. Guys, get in there, break some eggs, right? Make some omelets. Make mistakes as a brand new user. Use Simulator to be the, oh man, I just messed up, but it's cool. I'm still going to pay rent. Guys, when you simulate, what you're doing is you're building muscle memory. You're telling your body exactly how you're going to react when the rules are met. You're telling your body how you're going to manage these trades, guys, and practicing the way you want to perform. Treating every simulated dollar like it's a real dollar is going to help you make that transition into the real dollars. So don't practice the wrong trades. When you simulate, post in the room. Now, I talk about NinjaTrader in this room, and I also talk about TradingView. So when you post in my room, I don't have a lot of requests from you guys, but the one that I do have is if you are on NinjaTrader, I want you to tell me exactly what you saw, how you read the indicators. I'm going to give you this picture. So NinjaTrader users, sock that one away and learn how to get the best feedback. If you're a TradingView user, guess what? There's a way to annotate the TradingView charts as well. And all it is telling me how you read the indicators, and I can't find the picture. There it is. So I'm going to give you this picture. And if you are in TradingView, tell me what you see and why you did what you did. And if you're a NinjaTrader, tell me what you see and tell me why you did what you did. And then what happens is you get a private session with me right here in front of everybody. You get feedback on the way you read your charts. You get feedback on the entries that you took. You get feedback on the management that you executed. And if I have anything spinning in that Rolodex of a brain of mine to do it better, you get it from me. That's my promise. I will not hold back if you ask questions. The easiest way to get to where you want to be is to keep it simple. Keep it focused. Keep it very basic, guys. And if you look at the plans that I dropped in the room, whether it's NinjaTrader or TradingView, it's a pretty simple approach. It's only 2 charts. It's only 3 rules. There's an option rule there. It's exactly how to manage that trade. This is a trade, the high probability trend trade, that typically wins 70 to 80% of the time. The high probability trend trade is just a pattern. So you've got to learn what that pattern looks like. You've got to get it committed to memory so that every time it presents itself, you don't hesitate. The spreadsheets that I'm dropping in the room right now, this is your study buddy. This is your path to recognition through repetition. Only 3 rules. So if you're in NinjaTrader, it says Nexgen tracking sheet. In green is exactly what it looks like to have the 3 rules met. In red is exactly what it looks like to not have the rules met. That sit on your hands, that 90%. Over 400 pictures of Nexgen users presenting the pattern in the room. Guys, I'm telling you, go through 50 of these. It's going to stick in your head. A place to put your pictures. One of the most underutilized tools from new users is taking Snagit or Capture or Snippet tool or whatever you're using. And when you take a picture, this is our discussion. This is how we're going to talk. And you're going to take that picture, and it could be anything. You could draw an arrow, and the second you start typing, this process of annotation creates a link between what I see and what it means. So what you're doing is when you're taking these pictures, guys, you're saying, hey, this is a strong trigger line. And I'll show you exactly what I did for you guys, and then you should do this on your own. This is a strong trigger line. because the colors are all red, because the smalls are below the large, because there's space between strong triggers, odds, favorable, momentum. What you have done is you've taken a look and you've created these words to give you warm fuzzies. Now, every time you see strong triggers, all of this pops into your head. And what happens is you start leaning on these advantages and you start believing in these advantages and you start demanding these advantages before you enter a trade. So keep it really simple, guys. Know what it looks like to have your rules met. Commit as a brand new user to simplicity. Use that spreadsheet. Fill it up with pictures, guys. The more pictures you take, the more pictures you annotate, the faster you're going to get to where you want to be. We're going to talk about TradingView first, or I'm sorry, NinjaTrader first. NinjaTrader's been around with us for a long time, guys, and NinjaTrader and TradingView are just different platforms. Don't try to make one better than the other. They're just different. NinjaTrader high probability trend trade is only 3 rules deep. That's it. When a rule is true, you have an advantage: momentum, clear path, entry. These are the 3 advantages. It's the first 2 advantages that I really want you to focus on, because once you understand how to define momentum through strong triggers, and once you understand the very simple recipe for identifying a termination condition, making sure that your path is clear, you really have everything that you need to build a very consistent, very profitable trading plan. So only 2 things on your plate right now: learn how to identify strong triggers, learn how to recognize a termination condition, and then your first entry is the high probability trend trade entry, defining that point where the market is most likely to continue with the trend. Dang it, hammer time. I am singing in my head right now. Welcome to the room. These 3 rules only need 2 charts to make them happen. If you have a previous history of trading, you're probably accustomed to a lot of indicators on a lot of charts and different time frames, and more is better. I'm the exact opposite. I am very right brain, and it only takes 2 charts to identify this pattern. There is a large chart. This is where everything begins. This is the slow moving chart. This is showing the overall opinion of the market, and it takes the first bar, the most current bar on the large chart, to define the direction. That's through the background color. Green is up, red is down. How easy is that? The first bar will define momentum, rule number 1, with the strong trigger lines. And the first bar will define the areas that may be problematic. And guys, rules 1 and 2 are met on this large chart. And the only way you could turn my head to the right to look for a small chart entry is if the large chart rules are true as a brand new user. So when they are true, we're going to go to the small chart. And inside of that 1 bar that gives you 66% of the goodness is a retracement. That's that fight we were talking about. Typically a bounce from an area inside of triggers and continuation in a successful trend trade. All of this happens inside of 1 bar on the large chart. By using this little refinement process, you're going to be able to reduce risk dramatically. And you're also going to take that entry furthest away from the area that could stop the market, increasing profit potential. We use these 2 charts regardless of which platform you're using. It's a large chart, small chart, because I want you to remember that you're not in control. The market doesn't know you. They don't know you exist. They haven't heard what a big deal you are. Your 2 to 10 contracts means nothing. The large crowd is in control. The large crowd are the men and women with millions behind them, and they create trends and they establish momentum and they react at areas, and they don't know I'm here. So my plan says go with the large crowd. Go with their trend. Follow their momentum. Don't trade into the areas where they may react, because the large crowd typically wins. Good morning, Wayne. The small crowd, your small chart, these are the fighters. These are the men and women with still more money and popularity than we'll ever have. And they create that push, that fight, that retracement. A retracement, the clinical definition, is a small retracement counter to the underlying trend. So if everything on that big chart says up, the small crowd gives us a little shove down. We're going to pinpoint right where they fail, or where they're most likely to fail. That becomes your entry for the highest probability trend trade. We're going to use indicators. I don't want you guys overthinking this, please. Areas, you're going to hear that in the room. This is language that's going to become very familiar to you. What's an area, Mark? An area is a horizontal line on your chart that could create a bounce. How's that for the easiest definition ever? Yeah, just let me know. Let me know, Wayne. I want to go through rules before I go through charts, if that's cool. So when you get back, just repost them. I love that you post them early, but it's easier if you just say, hey, Mark, I'm back. Here's my posts. So I don't have to scroll up 75 lines to find them because I'm lazy. You know that. Thanks, Wayne. So areas, just think of it. These are bouncy things. They all have names. There are divergence highs. These are magenta lines, and they will print if there's a loss of momentum at a high pivot. So it becomes a line in the sand that can create a bounce. Divergence lows are the exact same thing. It just means that the market was losing momentum right at that point, creates a cyan line that could create a bounce. You're going to see Fibonacci support, Fibonacci resistance. These are single red and blue lines created through tens of thousands of calculations. These are the areas that you're going to define as where the market is likely to go, where the market is likely to stop most often. Fibonacci areas are where the large crowd makes decisions. Yellow one-to-ones are fibs in the moment. They can be resistance in an uptrend. They can be support in a downtrend. You're also going to see the mid-band. If price is above it, it'll be green. It can act as support. It'll be magenta. If price is below it, it may behave as resistance. So what you're going to say is that areas create bounces. Areas have the potential to make the market change direction. And learn the names, and we're going to talk about how to use them to take a trend trade. But the trigger lines, trigger lines show up in everything we do. And there's really only two trigger lines. Well, there's 4 lines total. 2 solid lines are your small triggers. These are small moving average. They're pretty quick. And whether it's a big chart or little chart, small triggers will always look like small triggers. Large triggers have dashes on them. And whether it is the big chart or the little chart, dash triggers are always large triggers. You're going to use the trigger lines first to define momentum. Strong trigger lines, rule number 1. And then we're going to use trigger lines to define termination conditions for rule number 2. And it's just a comparison of these trigger lines to these areas to let you know how it's most likely to react. And then finally, we're going to use the large triggers. On that smaller, faster chart, you actually have 2 sets of large triggers. You've got large triggers from the small chart and large triggers from the large chart. These are going to help you pinpoint your amazing entry so that you can get into the market with the least amount of risk and the highest level of accuracy. Triggers do 99% of the lifting, guys. All you need to know is that these are small and these are large. And when they're green, they're going up. And when they're red, they're going down. So what we're going to do is we're going to break down these 3 rules. And I'm telling you right now, if it's day 1, it's a lot coming at you. If it's day 2, it's going to start to make sense. Typically by day 3, most people are like, okay, the language is good. Now I can start focusing on these rules. Everything starts on the large chart, always. And the large chart must have strong trigger lines because without the advantage of momentum, I don't even want to look for a clear path. And strong trigger lines, in my humble opinion, is the easiest lesson that you'll ever get. Strong trigger lines has nothing to do with price bars. Strong trigger lines has nothing to do with these areas, guys. Strong trigger lines simply means that in an uptrend, when the background is green, small and large triggers are green as well, going up, and your small triggers break above and away from your large triggers. And it's space created between the two that lets me know that the odds are favorable for the market to continue up. And you're going to see this annotated on charts a lot. You're going to see somebody write down OFM. Or if you're Pete, Big Mo, the big momentum. And guys, strong triggers is rule number 1 for a reason. In a downtrend, larger red, smaller red, space between. When the smalls break below and away from the large triggers, that space lets me know that the odds are favorable for the market to continue down. Odds favorable momentum pushes a market. Odds favorable momentum is what we look for to break key areas, guys. Odds favorable momentum will even cover some of those mistakes that we tend to make as new users. I think one of the easiest ways to recognize odds favorable momentum, and I'm a visual kind of guy, think of scissors. And when scissors are open, they can cut. Or as my buddy Jerry says, when scissors are open, they can cut you a check. So it's that separation, those blades apart from one another, lets me know that I have the advantage of momentum. And what happens when the scissors close? When the small triggers are no longer separated from the large triggers? This is what we call weak triggers. And weak triggers, anything can happen up or down. Weak triggers is where you'll see the market kind of retrace from the middle of nowhere. Weak triggers is where key Fibonacci areas are more likely to hold. So as you go through, strength is always separation between the small and large. And what's cool is that little tail on this big chart, that's that pullback on the smaller, faster chart. And you'll actually use rule number 3 to pinpoint where these tails are most likely to form with all that momentum. Strong triggers up, strong triggers down. And guys, strong triggers are hard to stop. Strong triggers have nothing to do with areas. Strong triggers have nothing to do with price bars. Separation is strength. Is everybody good with that? Do I have any newer users trying to grab hold? Guys, this is the easiest lesson that I do. If you remember separation is strength, it's very difficult to make the mistake of trading with weak triggers. Once you have that strength, you've got to make sure nothing is in the way, guys. No termination conditions, because we want room to profit targets. What's a termination condition? Well, it's a Fibonacci-based indicator with the potential to stop the market. How's that for a wordy little thing? Guys, termination conditions are going to be horizontal lines on a large chart. Those areas are where the large crowd make decisions, where buyers buy and where sellers sell, where fights happen, where profits are taken. And guys, you're going to see them long before you ever get there. And there's a very simple recipe for making sure that you're not trading into a termination condition. And I want you to remember the large crowd makes decisions. So the recipe, I like saying the recipe because when you follow a recipe, you get the results you need, right? Let the large crowd get there. Let the buyers push until they reach an area of resistance. Let the sellers take over and drive the market down until they reach an area of support. That is the first part of the equation. Price reaches an area. Price reaches support. Price reaches resistance. And guys, once it gets there, I'm done with price. I don't need price. Price has absolutely no bearing on whether or not it's a termination condition. I want you guys to get in the habit of asking out loud, where are my triggers? When price reaches resistance, where are my triggers? Well, all of my trigger lines, all 4 lines remain below that area of resistance. Or all 4 trigger lines remain above that area of support, guys. That is the textbook recipe for a termination condition. When price reaches an area and 4 triggers remain below resistance or above support, that area is more likely to stop the market. Exhibit A, B, C, D, E, more likely to stop the market than it is to just arbitrarily break. But they do break from time to time, typically with momentum. But guys, every time price reaches Fibonacci support, even if I have strong triggers, I have to pump the brakes. I'm going to wait and see what the large crowd wants to do. To the tick, even with momentum, that's where the market reversed. Does that make sense, everybody? You can identify termination conditions with a simple recipe. Price reaches the area, where are my triggers? That's it. And if they're below resistance or above support, sit on your hands. Wait for the reaction. And guys, there are a couple different reactions that are going to happen. The first reaction that could happen is that the market reverses completely from that key area. If it does, we call it a strong top or a strong bottom. Now, this is the first rule when we're trying to trade the potential of areas to break. The second thing that could happen is, well, you may get a little reaction. Maybe the sellers give it a go, but the buyers tell them to get bent and take back over. And this reaction is typically enough to pull you out of a position to create a loss, and it's what we call an avoidable loss. And then finally, it might just break. Now, here's the part that I really want you guys to latch onto. I will never, ever know what the reaction will be. Guys, alleviate yourself of that burden of trying to predict. I'll never know what the reaction will be. So if price reaches an area and the triggers do not break, I choose to wait. Rule 2 not met. Does that make sense, everybody? Price reaches an area, no triggers, no trades, sit on your hands, do nothing. If it's going to reverse, we'll use that momentum and look for a trade in a minute, right? If it's going to bounce, we'll sit tight. We'll see what they're going to do. And if it's going to break, it's going to look like this. Your triggers will tell the story. First, it reaches a line. Every line you reach is a termination condition. Every time you reach a line, it's a termination condition. Every time. So watch this. The market is screaming up with momentum. Oh my gosh, life is good. Can't believe it. Gonna be hard to stop. This is awesome. There's a long trade. Bunk. Let's take it up to resistance. And with all that momentum, that right there says, okay, Mark, don't initiate another trade. And your brain is going to say, but Mark, look at the momentum. It's got to break. Mark, look at the momentum. That stupid red line's not going to stop the market. So you get in the market and the sellers say, ha, we got your money. Oh, you're going to move your stop? Bigger loss. Yeah, sucks to be you. Should have respected the red line. And I know that I'm being a little dramatic, right? But guys, I'm telling you, if you learn to respect these lines, you can avoid the most broken rule by new users, trading directly into them. Wait for the reaction. If it's going to break, it'll start with the small triggers absolutely smashing through that area. Your small triggers will just decimate Fibonacci support. You're going to have all the momentum you could ever hope for, and you're going to say to yourself, this area now has the potential to break. And the second trade on the plan that I gave you guys is trading that potential. The potential is higher with 3 trigger lines through the area. Not dramatic at all, Sergio? Damn it, I was going for dramatic. Guys, when 3 trigger lines smash through that area, get below support, this is your best of the best. I've handed you a plan to trade that. But a path is not clear, guys. It is not clear sailing until all 4 triggers get below that area. And once all 4 triggers get below that area, the path is clear. Rule number 2 is met. Your path remains clear until you reach the next area. This is my picture for the potential to break. It's only the potential. That's it. And guys, until it's clear, this is a very real scenario that could happen. I'm going to give you a plan to optimize your chances of success. But absolutely no trades. Let's manage this potential to break assertively. Clear path, clear sail until we reach the next line. Is everybody good with that? Price reaches support. None of the triggers break. I wait for the reaction. The reaction is a reversal. Now it's a strong bottom. And I can't find a long. I'm looking. There wasn't one. And then I hit resistance. And I have to say, damn it. I have to wait for the reaction again. And then I get the potential to break. And I'm like, oh, if I get a pullback on that smaller chart, man, I'm going to enter, but I'm going to manage it assertively because it's only the potential. But once 4 triggers clear through, egads and little fishes, guys. It's the easiest trade you will ever take. Trading away from Fibonacci, using momentum, nothing in the way. Let's pinpoint where those tails are most likely to form. Breaking through Fibonacci resistance, it becomes support. I've got momentum. Let's define where the tail is most likely to form. Let's take the highest probability trend trade, give ourselves the best chance of success as a brand new user. More bad news. Not only you're not in control, you alphas, but guys, there's going to be times where your path isn't clear. You're going to see fib after fib after fib, or fib into divergence into yellow one-to-ones. You're going to see weak triggers, and you're going to be like, son of a gun, I can't seem to get my rules met. I can't find a clear path. They're not giving me the momentum I need. And I want you to have it written on a piece of paper in front of you. 90% of your day is doing jack squat, waiting for those advantages, because those advantages create an edge. Guys, the futures markets trade billions hourly. The S&P exchanges more than $174 million a day. The NASDAQ is like 270, give or take. Guys, it takes $400 a day to be a six-figure trader. $400 a day. That's it. And then you can just start copying accounts and make it even better. But I'm telling you, you don't have to be the first one in. You don't have to be the last one out. Allow it to be easy. Allow the market to tell you what it wants to do. Let the market say, hey, guess what? I'm stuck in between Fibonacci resistance and support. I don't mean to be a burden, but until I get out of this range, shit's not going to be easy. And then you have to make the decision, I'm going to let them get out of that range. They will. They're just talking things over, guys. That's all it is. So momentum leads the way, guys. Strong triggers break things. Strong triggers push a market. Strong triggers even cover the mistakes that we tend to make as new users. No termination means that I can ride that wave of momentum and go where the market is most likely to go, that I have such a driving force and nothing to create a bounce that I am ecstatic and excited about going to the smaller, faster chart, looking for rule number 3. And now the language for entry. Guys, I'm a huge language nerd. If you learn this phrase, hold on. I made a picture for it just for those of us that like to see things. If you learn this phrase right here, if you commit it to memory, if you don't deviate as a brand new user, this is the keys to the kingdom, guys. You will call your shots. You will force the market to come to you, and you will wait for it with a limit order. And with that limit order, you will buy or sell a pullback, that little shove created by the small crowd. And you will buy or sell that pullback at an area, at a fib, at a yellow one-to-one, at a mid-band. Because why? Areas are bouncy. But that area must be inside of triggers, because your triggers will define exactly where that retracement is most likely to go. Your trigger lines will tell you where the pullback is most likely to go. Your area inside of that trigger will show you where the market is most likely to continue. And with a little bit of study, you'll have the confidence to activate a limit order right at that area of support, right inside of triggers. And you're going to feel like a pretty big deal when you buy the low tick or close to it, guys. So it's just a pattern. I can't stress this enough. Your entry, your trend trade, it's going to look the same every time. It's going to start with momentum on the large chart. Your large chart is going to say, hey, guess what, Z-Robot? I don't know if you knew this, but we want the market to go up. And not only do we want it to go up, we're pushing it like it's our job to push it. And maybe you didn't notice, but there's absolutely nothing in the way. You have the best case scenario on your large chart. It's cool to go to the small chart. And guys, we're going to let the small crowd fight. They love to buck the system. And it begins with a reversal bar. And a reversal bar is not your entry. A reversal bar actually happens to be a little killer of momentum, hopefully enough to get us back to the area inside of triggers. So when this reversal bar prints, you're gonna squash the desire to enter the trade, and you're gonna say, you know what? I know exactly where these down bars are most likely to go, somewhere inside of those large triggers. Remember the dashed lines? You've got them from the large chart and the small chart, double the accuracy. Somewhere from that top line to the bottom line is where this retracement is most likely to go. So I refuse to panic as long as it's above the bottom line. But it's the areas inside. Fibs, midbands, yellow one-to-ones. This is where the market is most likely to bounce, where the small crowd is most likely to lose their fight, where the large crowd is most likely to take over and push it in the direction of the underlying trend. You may have multiple areas, creates a window. I call it the window of opportunity. If you're a Ric Flair fan, it's the woo. Guys, you're going to activate a limit order just above the highest point of support. And you're going to taunt the small crowd and hope that they get to you. And if they do, you're in the highest probability trend trade Nexgen teaches. You're in a trade that not only has the advantage of momentum, which is going to be difficult to stop, you're in a trade that had absolutely nothing in the way on the big chart to force decisions, and you are in where the market is most likely to continue. And this very simple recipe is a trade that typically wins 70 to 80% of the time. And because you've defined where the market should retrace, where it's most likely to bounce, you understand where the market should not go. Once you get below those trigger lines, beyond the retracement zone through the areas likely to create a bounce, this is where your initial stop goes, guys, about 4 to 5 ticks below trigger lines. And what happens is you say, I've got everything working for me. This is where my advantage runs out. This is where I choose to take an exit. This is where 20 to 30% of the time, if I'm following the rules, I'm going to cut ties with this trade, and it's okay. Guys, losses are not failures. Losses are great trades that just didn't work. 20 to 30% of the time, you will incur losses. We can cut them short by knowing where the market shouldn't go. We'll cut them even smaller, and this is pretty cool. If you get a reversal bar back in the direction of your trade, we'll put our stop just below that reversal bar. And it's not uncommon to see you guys with like 4 or 5 ticks of risk on a trade. So up or down, doesn't matter. Both sides of the buffet, right? Guys, in a downtrend, when the momentum is strong, when the path is clear, we're going to wait for the fight. The fight begins with a reversal bar. And the reversal bar says, hey, go pinpoint where the retracement is most likely to occur, somewhere from the bottom to the top of the large triggers. But understand that triggers aren't bouncy. Areas are. Look for the area inside of triggers. And man, it's a magical moment. There is one line inside of those triggers, a midband. All you have to do is activate a limit order just below that area and taunt the small crowd. Leave some cookies and milk out, right? And if they get there, you're in the highest probability trend trade ever. Understanding fully that any areas above those triggers are not a part of the entry equation because that's where the market shouldn't go. No entries are taken from the wrong side of the triggers, guys. This is where stop placements go. Once the market gets beyond those triggers, you don't know if, when, or where it's going down. You don't know if, when, or where it's going up. All you can do is trade the pattern, and the pattern is consistent. Victor says, man, having to wear a bucket size hat to manage trades today, not impossible, and risk has been low on my trades, but I'm going to chill now. Try to get stressless trades, if any. Will stop early today since feds are talking, trying to bring the market down. Man, that sounds like an opinion, Victor. Maybe they're going to lift it up. Maybe they're going to surprise you. Whoa. Maybe when you have momentum and at least the potential to break in an area inside of triggers, maybe you just say, F the feds. This is a pattern that typically wins more than it loses. I'll take it. Guys, this is your pattern on 2 charts. Remember when I told you would pinpoint where those tails are most likely to form? There it is. Pull back to the area inside of triggers. That was from the beginning of November. There's the exact same pattern from 2021 and the exact same pattern from 2022. And man, just at the risk of seeming, oh, I don't know, let's say braggadocious, right? If I back up, didn't we circle a tail or two together? Let's go see what that tail looked like. Bum, bum, bum. Oh, they didn't quite make the mid-band inside. That's probably not my money. It doesn't make a difference, Andy. Let's see what that one did with the potential to break. Boom, right to it. Now we're starting to see some patterns. It doesn't matter if the market goes up. It doesn't matter if the market goes down. It's just ticks. That's all it is. It's up and down movement. And I know some of us have biases, right? Some of us see longs easier than we see shorts, and some of us see shorts easier than we see longs. Guys, I'm going to encourage you. Instead of looking for long or short, look for rules met. Trade the pattern. Follow the process that yields the results. Well, when the Feds talk, Victor, when there's high impact news, you don't know what the reaction's going to be. Because, Victor, you might hear the Fed's news and get excited and pour $1 million into the market long. And I might hear the Fed's news and say, I hate the Feds. F the Feds. There's your t-shirt. I'm going to dump $2 million into the market short because screw those guys. Guys, there's no telling what the big crowd's going to do, but we do know exactly when they're going to do it, when they're most likely to. High impact news, right? Tomorrow morning at 8:30 a.m., I don't give two squats about unemployment claims in regards to my trading. But I know that 8:30 a.m., someone who does is likely to react. I can stay out of the market. I can sit on my hands. I can do nothing instead of trading the insanity. Are there any questions about the high probability trend trade? Guys, it is 3 rules. It is 2 charts. I don't know how to make it any simpler than that, but you will have to study it. You'll have to learn momentum. You'll have to learn that magical phrase, price reached an area, where are my triggers? And once you get it, it's keys to the kingdom. And now we're going to go to a different kingdom. We're going to go to TradingView. So TradingView is just a different platform. If you are with Nexgen Pro Trader Funding, and I do hope that you are, this is probably the platform that you're on. I'm going to tell you right now that, and I'm just going to say it boldly. If you learn how to follow the TradingView KISS plan, I've had more than a lot of people pass evaluations using this plan. Nothing but the trend trade. I've had people pass. I've had people in this room, myself included, pass it. And do you know when things go sideways? When they stop following the plan. You know when a diet stops working? When you skip celery for cupcakes, guys. So learn the plan. I'm about to give it to you. It's pretty easy. It's only 3 rules. Cupcakes are amazing. It's only 3 rules. It's only 2 charts. Stop making it harder than it needs to be. You have a 15-minute chart and you have a 1-minute chart. Now, if you're accustomed to Rinko, you're like, but Mark, I don't know anything about minute charts. Minute charts are foreign to me. I don't even know what to say about minute charts. Guys, minute charts are nothing new. Nexgen's plan from 2004 and 2005 was a minute chart with a pullback to an area and an entry for a trend trade. You're about to learn the 2026 version of it. Big chart is 15 minutes, guys. It takes 172 days for a 15-minute bar to produce. Not really, that doesn't even make sense, does it? 15 minutes is a long time. Hell, Victor might be back before the next bar prints. So we're going to use the big chart for direction. We're going to use it for momentum. And that momentum is only a factor in management. I'm going to teach you how to know how to manage before you ever enter. And then we're going to use it for key targets and terminations. Your 1-minute chart, well, this is where the fighters are. This is where we see that pullback to an area. Guys, we're going to define entries, and we're going to use this to define the immediate strength. TradingView has indicators. Large chart, good morning, Miss Trina. Large chart doesn't have background color. Large chart doesn't even have large triggers. Guys, I'm telling you, if I can make it easy, I'm going to make it easy. You have, well, they're essentially just small triggers, and they're either up or they're down. Cyan is up, white is down. Your 1 minute chart has two sets of triggers. Sorry for the confusion. Small triggers, cyan and blue, or cyan and white, same thing, up and down. And large triggers, green is up, red is down. This is the immediate strength of the market. And I'm going to be honest with you, if you're a trend trader, you don't even need the large triggers. It's all small triggers. TradingView has areas. These are nothing new. These are the T3 indicators. These should seem familiar if you're old school, and they're not hard to learn if you're new school. And guys, I would encourage you, can't demand, I'm not a demanding kind of guy, but I would encourage you to learn the names and how they react. So once again, divergence highs, divergence lows. Guys, these are loss of momentum. These divergence highs and lows can be used for targets. They can be used as termination conditions. One-to-ones can be used as targets, terminations, or entries on the 1 minute chart. Mid-band can be used as a target, a termination, or an entry. And these outer bands, you don't see these on NinjaTrader. These are just kind of points of exhaustion. It's a channel. We're going to use these for targets and for termination conditions. Learn how they're used. There's two ways. This is the T3 indicators. And I should have talked about this. A lot of you have chart prime, which gives areas of supply and demand. Some of you may have the support and resistance areas from flux charts. Some of you may have algo alpha giving supply and demand. These are both free options if you don't have chart prime. And they're both pretty stinking good, to be honest with you. So if you have chart prime, if you have algo alpha, if you have flux charts, guys, those additional areas are support and resistance. If the market is trading down, they behave as support. If the market is trading up, they behave as resistance. They can be used as targets, terminations, or entries. So depending on what you have, depends on what you're going to see. If you go to the Pro Trader funding, if you go to the instructions, there are workspaces built already. Let me find it. One that uses the flux charts, support and resistance. Boom, right there. One that uses the chart prime market dynamics, guys. So everything is pre-built for you. And then we're going to use these indicators to define a trend trade. This is my favorite set of rules because the first two rules are literally the same rule. So we're going to define the trend. Your big chart can't trade into anything because areas create bounces. The 1 minute chart's not trading in anything because areas can create bounces. And then we're just going to let the fight happen, guys. We're going to buy or sell a pullback at a 1 minute area. Mid bands, one-to-ones, it could be a zone. But there's a little bit that takes some of the risk off of it, that gets you on the good side of things, and that's going to be a close on the weak side of the triggers. And we'll talk about exactly what that looks like. But let's start with direction. What happens to mark classroom charts on that page? So Trina, what we realized is that Mark's classroom charts are the same for every time frame. Not time frame, for every market. So if you're using chart prime, you can open it up and all you have to do is, here, watch this. If I bring up TradingView, so this is the NASDAQ, right? Watch this. Now that exact same chart is silver. And I don't need to change any of the indicators. I don't need to change the background colors. I don't need to add anything or pull anything. What I'm teaching you right now works on everything. So we just did it to clean things up. Watch this, feeder cattle. Did you guys know that you could trade feeder cattle? And you can define direction with the 15-minute triggers, and you can not trade into areas. How cool is that? Everything that I teach, guys, I don't care what you trade. Learn the patterns, define direction. Direction is defined with the 15-minute small triggers. It's either up or down. Let it be that black and white. They're either going up or they're going down. That defines direction. If they are sideways and lifeless, the large crowd can't figure out what to do, you don't have to guess. Once I define direction, I have to have room to target. So from wherever the market is, do I have room before I hit an area? Do I have enough room to make money? Does that make sense? In this particular picture, the triggers are up. From where the market is currently, I have more than enough room before I run into something that could create a bounce. That's rule one met. That's what it's going to look like. I do the same thing on the small chart. Small chart, from wherever I'm going to enter that trade, do I have room to make money? Now here's the magic question, right? Mark, you keep saying room to targets. What is room? Is it $50? Well, I think that's pretty damn tight and it doesn't give me any time to react. Is it $100? If you're good and you can react quickly and you know what you're up against, that may be plenty. Is it $150? That gives you a lot of time to react. And if it's $200, man, you're good. You're like, hey, this is awesome. I got more than enough time to react before I have to start making decisions about this trade. So guys, you're going to have to figure out what your room to targets is. My personal is $100. Some of you will take $20. Some of you insist on $200. It's personal preference. But if there's room for my entry, it's time to go define an entry, guys. And the entry looks the same. You can trade a bunch of stuff, Victor. The entry always looks the same. You guys remember that we're taking the fight, right? So in this particular trade, the large chart is up and the large chart has room to targets. And the 1 minute chart right there where those small triggers roll says, hey, Trina, the fight is on. Victor, the fight is on. Papa, the fight is on. Pablo, the fight is on. And if you just listen to yourself and say, well, I need a pullback to an area, draw a box, call your shots. This is exactly where the market has to come for me to take this high probability trend trade. And when the market gets there, it's a little different than Ninja Trader. We don't just jump in. There is no we. If you're following the plan, you don't just jump in. What you do is you wait for one very specific look. For a long trade, you want a green bar because green means up, and that's the direction you're going. And you want that up bar to have both corners of it. And you can see it right here. One corner, two corner. That is a close on the weak side of the triggers. And guys, the weak side of the triggers is where reversals happen. When the market is going up, when you get below those triggers, that's where it tends to go down. And when the market is pushing down, when you get above those triggers, that's where it tends to go up. So your entry will look the same every time. When the small triggers are up, the direction is up. I'm only looking for long trades. Guys, I'm going to tell you right now, and this is interesting to me, and this creates anonymity, don't worry. But my job is to watch people trade in the funding company and to see what they're doing, and to analyze people and the way they approach the market. And one of the things that I've noticed, and I hope I don't get in trouble for doing this, and I don't remember what day this was, but every account was in a short position when the small triggers set up. Every account is in a negative status, fighting the overall trend. Guys, when I tell you what I teach in this room can be used to pass the evaluation, Does it mean that there's not opportunity counter trend? There is. But until you can just learn to go with the flow, guys, you're fighting. So when it's up, let it be up. I just wanted to share that picture. I made that picture. I sent it to my brother. I was like, I just want to call everybody in a trade right now and say, come to my classroom. Stop fighting. When there's room to targets, I'll go look for an entry. Small triggers roll, the fight is on. Market pulls back to the area. We're almost there. Close on the correct side of the triggers. Let's go long. And sure enough, that's where the small crowd loses and gets back in line with the large crowd. Do you see that? First it's up, room to targets. I don't have to jump in up here. The market moves in patterns. There's your pattern. Pull back to the area, close above. Both sides of the buffet. Down, room to targets, pull back to the area. There's your down bar. There's continuation. I do rat you out to my brother. Guys, one of the things with the Nexgen funding company is we're looking for professional traders. We're looking for people. We want to copy your trades. We want to do what you do because you do it so well. And the one thing that we're finding is that people like to fight. People hate to wait. There's some people that do an exceptional job. One of them's in this room. I won't call them out. But trading with the trend, being willing to take profits, guys. There's ways to beat evaluations, and it's not home runs. It's great entries and good management. And speaking of management, you can use price location against those small triggers on the large chart to know exactly how to manage your trade. So management starts with that comparison. I'm going to find the most current price, and I'm going to see where it is in relationship to those small triggers. And there's only three options. It's either left, right, or inside. If I'm left of the triggers, I'm on the strong side of the triggers. The strong side of the triggers is where 1 minute areas have a better shot at breaking. The strong side of the triggers is where bigger moves typically happen. It doesn't give you carte blanche to trade into areas. It doesn't say, hey, break rule number 2, don't worry about the 1 minute. But when you get there, you may be more inclined to hold, to look for bigger moves. The right side of the triggers, this is the weak side of the triggers. Doesn't mean that it's a bad trade, a negative trade, a lower probability trade. It just means that the 1 minute areas are more likely to create a bounce, which means that before I ever enter that trade, I know that I'm going to get paid at that area. Is there any people getting paid from the prop company in this room? Probably. I don't know. I hate to put anybody's business out there. But there's quite a few people that are making money, Victor. And the recipe is the same. Thank you. I didn't want to call you out, DL. Taking over $45,000 from the prop firm. DL, would it be safe to say you have a trading plan? I know you do. I look at your trades. Guys, I'm telling you, same thing every day. Same trades every day. Same entries every day. Same exits every day. The recipe isn't finding more. It's taking the best. Thank you for posting in here. I don't like to put people's business on the street, but I love it. I would be so proud if I were you. You're killing it. Guys, you can know exactly how to manage your trade. Strong side, 1 minute area is most likely to break. Weak side, it's okay to get paid, get out, wait for the next trade. And guys, transition, this is that split contracts. This is where I get to a 1 minute area. Maybe I take half off, get to break even, see if it wants to go further. Because the 15 minute is a slow chart and you can go from weak to transition to strong. You can also go from strong to transition to weak. There's a lot that happens in a 15-minute bar, but you'll never be surprised on how you need to manage if you just learn the recipe. And guys, that is my first hour. It's the same hour every morning. There's the PowerPoint that I used to teach every day. So you can go back and look at those pictures. There's the plans that only have 3 rules and 2 charts. That's pretty awesome simplicity. There's the spreadsheets that show you pictures of everything. And one of the things that I think I'm most proud of is that there are no secrets. Guys, there's no secret handshake. There's no need to buy more indicators so that you can get the complete picture. You have the rules. Now it's up to you to learn them. You have the ability to post in this room and get feedback on everything that you do. It's up to you to post in the room. I won't beg you. I won't beg you. And you have the ability to keep it simple. So after the first hour, we go into the second hour because it seems like a pretty cool order of operations. And in the second hour, we are dedicated 100% to feedback on the pictures that you guys post. And we also will take trades if we get them. Guys, if the KISS plan is met, if we have direction, if we have areas, if we have rules met from the KISS plan, I'll pull the trigger in the room. I'm perfectly fine doing that. But I want to share something with you guys. Most of you have heard this. Some of you have not. And this was a response to an email that I was sent. And I appreciate the spirit of the email. But the email came from a guy or a gal. I don't want to suggest which, right? And they took it upon themselves to be the trade police. And they were mad as all get out that Pete had the audacity to post a trade that wasn't high probability, that Wayne had the gall to not wait for a pullback to an area inside of triggers. And they were livid. Guys, trading is an individual sport. And the key to all of this, have a foundation, build a foundation, let it be super freaking easy, and then grow from that point, understanding the basics. So for all of you new users, I blanket very conservative rules, recognition of advantages, and a solid plan that optimizes your chances of success as you learn to read your indicators. So for you new users, all termination conditions are bad. And for you new users, not having momentum is just 32 flavors of suck. You don't want to take that trade, right? It feels that way. Areas beyond triggers for entry, what are you thinking? It's ballistic podiatry. You're shooting yourself in the foot, guys. But the reality is that these things aren't always a negative. But until you get the repetition to understand when to make exceptions, there's a way to optimize your chances of success, to build that confidence through the memory of success. And the more time you spend with the software, the more you'll see. Now, here's one of the challenges. There's a big difference between your read, because you're seeing more, and the rules. So make sure that you're focused on the rules and let the read verify that the rules are true. Guys, you've got to learn the process that yields results. That's what I teach every day. I teach the process to entering the market. I teach the process to management. And the results tend to follow. That's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay, not looking for all the trades, only the best trades, you can find an extraordinary level of success. And I've watched it repeatedly over the years. The further new users, key word, the further new users deviate from simple, the longer they tend to take to be comfortable with pattern recognition, the longer it takes them to reach their goals. So question everything. I encourage it. I want it. I want to hear from you. I want this room to be a discussion. But I also want you to give yourself a little grace, guys. If you are brand new, let yourself be brand new. Give yourself permission to make mistakes. Give yourself permission to not be $1 million trader 3 weeks into owning the software. You're on a journey. I'm going to take that journey with you. And that journey begins with posting in the room, telling me what you see, talking about your advantages, and we're going to turn those advantages into trades. So let's see what the S&P says. My small triggers are down and my large triggers are up. I don't have momentum. If I were trying to go up, I don't have enough triggers through one-to-ones. And if I were trying to go down, I don't have any triggers through support, and I'm pretty much in a big state of do nothing. I don't have rules met that fit the KISS plan. So I choose to do nothing. In the NASDAQ, price or triggers are up. Let's make this big so you can see it. The trend is up. My most current price has absolutely nowhere to go before it hits those yellow 1-to-1s, which means couldn't care less what's happening on the small chart. No rules met. So I'm going to take 5 minutes. And when I come back, we'll start looking at the charts that were posted. We'll do the live chart read. Price reaches an area. Where are my triggers? Does everybody see that as a termination condition? Price reaches the area. Where are my triggers? That's the whole recipe. It doesn't get any easier than that. Price reached the divergence low. Where were my triggers? Price reached resistance. Where were my triggers? Where were my triggers? I mean, my goodness. The S&P is struggling, right? I appreciate that, Boaz. I love what I do. Guys, this is fun for me. Like, I wake up excited. I dream about ways to make this classroom better. I hate to admit that because my brother's going to stop paying me. He's like, this is a hobby. But I do appreciate that, Boaz. Thank you for that. I'm going to walk away for a few minutes, guys. When I come back, let's see what you guys have posted in the room. Go stretch your legs, everybody. All right, guys, let's do it. I didn't mute YouTube, and I was making silly sound. All right, guys, let's do it. I didn't mute YouTube, which is kind of funny because I was making silly sounds through a toilet paper roll for my dog, and that will show up on the video. Woo, good stuff. All right, guys, we're going to talk about what we call the gap theory real quick. And the gap theory says that if price reaches the Fibonacci area, and these large triggers are a full bar away, price returns to large triggers. There's a chance that it will close the gap to those large triggers, especially if it's not coming from a strong top. So I'm going to just do this right here, and let's see if it closes the gap. It's not obligated to, but guys, this is one of those things that's going to define your mid-band as a termination condition. Learning the gap theory helps out a little bit. Oop, and they may push, right? It's all probabilities. So I'm going to scroll up. We're going to look at what's been posted. Bum, 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 bum. That's yesterday. We're going to start with my friend Joel and that guy and that guy and that guy. Let's put this guy up there too. And that guy. Wayne, are you back? I thought he was. I thought I saw some shenanigans coming out of him. Miss Trina posted in the room. Make sure I don't miss anybody. And guys, I did want to share with you, if I ever miss one of your pictures, he's still out, no worries. Like, if you ever post in my room and I miss it, it's not because I didn't want to look at your picture. It turns out that I'm human, and every now and then I make a mistake. So all you have to do is go, hey, Mark, seriously, we missed it. Here it is again. Let me repost it. And I'll be like, thank you for that. All right. So Joel got us going, and he says, check it out. I've got some rules met, and termination reverses the market. That's a yes. That's like not mandatory, but a bonus. Strong triggers on the large chart. And guys, I am obligated to say that that is not a factual yes. I'm going to show you one of the things that happens, especially among new users. And we mentioned this yesterday. Someone else mentioned it. We will write what we want it to be, not necessarily what it is. That's just, it's human nature. So strong triggers always looks like this, is always separation. Here I don't have separation. That has to be a no. If you say yes, you're deceiving yourself. No termination conditions on the 13.2, that's a yes. Area for entry inside of favorable triggers. That's decidedly no. And guys, what we're looking at here is a trade, and I love this. This is such a good example. And I'm going to do two different things with it. So this is a trade that if we go back to what the best trade is, momentum path and entry, we literally have, by new user standards, nothing more than a clear path. Does that make sense, everybody? I want to show you the growth process that we're all going through with the software. For the brand new user, can you guys hear me? Am I good? Make sure I'm not just talking to myself. Nobody? Got volume? Okay, thank you, Trina. So I'm going to talk about the fact that, oh my gosh, Joel, you gave up 60%, 66% of your advantages. And then we're going to reshape it. And we're going to say, well, we've got some experience here. And there's this idea that for the brand new user, in order to optimize chances of success, it's imperative that you demand those odds favorable momentum triggers because it is always the best of the best. But this is kind of the natural progression. That's always the best. And then with both triggers down and one of the small triggers gets inside, my experienced users don't say, well, that's it. They say, you know what? I've still got some momentum. It's just not the best momentum. I'll look for some opportunities. And there's even some of you that with weak triggers will say, well, I still have a clear path. I can define an entry. I'm willing to take that trade. And Joel just exercised his right to be a more seasoned user than the new user. So he has enough momentum for his liking. He has absolutely nothing in the way, but he doesn't have an area inside of triggers. And this is the only one I think that could create the biggest problem, because from no area. I don't know if the market's going to bounce at the mid-band. I don't know if it's going to bounce at the fib. I don't know if it's going to bounce at the 1-to-1. They're all on the wrong side of the triggers, so I've got to make a decision. Where do I put my stop? That's my go, not my stop. There we go. Is everybody with me so far? This is what happens when you learn the software. Price reaches Fibonacci support. All the triggers are above. Well, the rules of termination conditions say it's more likely to bounce than break, which means it's more likely to continue up. The momentum is still there a little bit. There's nothing in the way. And Joel says, I'm going to take this trade from the mid-band, and I'll put my stop below the fib that's most likely to create a bounce. Guys, this is a trade that doesn't have the best momentum. This is a trade that doesn't have a defined entry area. And this is a trade that gave 3 divergences in the same price range, which is a small chart termination, so Joel got out. And this is beautiful use of Fibonacci. This is beautiful use of trigger location, and this is beautiful use of a pattern that could stop the market's forward progress. So while I could only find one high probability trend trade rule, guys, this is where you're all headed. Making good decisions, making trades, having a plan that revolves around the advantages and not necessarily that very core high probability trend trade. Good job, Joel. I hope that made sense, everybody. Triggers are down, 3 triggers through, has momentum, missed the best entry on the wake up, caught it on the second leg, out at 15-minute trouble, just a trend trade. I'm not only the president, I'm also a member. That was my trend trade this morning when I woke up. Victor, everything is up and Victor's calling his shots. Come back to me. Give me the fight. Give me the pullback. I'll take that trade if you just give me the pullback. Trend trade against all odds. Trend is up. Weak side, manage it aggressively. Nothing in the way on the large chart. Price pulls back. Close above. Out at trouble. Do you guys see it? Victor patiently waited for it to get to the area. And when it got to the area, he didn't just jump in. He let the market close on the correct side of the triggers. This is everything that we talked about this morning, guys. And Victor, it's perfect execution and intelligent profits. Nicely done. This is just my picture. This is Norbert. Guys, you're not in control. Be a remora. Same thing. Calling his shots. Come get me. I'm ready. Come get me. And Wayne is not back, right? So I will close out everything up to Wayne. And I'll just have him on standby for when he gets back. Thanks, Trina. I feel like you saved my bacon in this room a lot. I'll send you something nice for Christmas. Trend trade. The trend is down. Price is on the weak side. He knows how to manage. Space to the next area on the large chart. Pull back to resistance. Close below. It's a little tight, right? I get that. I love that, though. It's a little tight. Couldn't we agree, Victor? 2 ticks to trouble. From the weak side of triggers, Victor takes a chance. He says, you know what? I've got room on the big chart. I'm willing to take a shot. And it works out beautifully for you. Nice job. Did not believe it would last. Why? That's interesting. Took profit at trouble area, then get out too soon of entry. I don't know. Did you get out too soon? You made 100 on that one, 180, what, $280? It took you 3 minutes to make that $280, Victor. Do you suppose there will be more trades during the day? And Victor, if I could, I want to point out that he puts not my money. He says, oh, I got out too soon because the entry on the weak side. But it's not my money. He goes, my plan says get paid with that look. And Victor, I love that. Victor recognizes that every trade's not going to be a home run. Victor even puts on his annotation, it's okay, it was on the weak side. That area could have created a bounce. I love it. Guys, that's knowing exactly how you'll manage a trade before you ever enter the trade. Nicely done, Victor. All right. The triggers are down. They're in transition. There's room to targets. There's a close below. And man, they just got you, Trina. They just got you. Did it close below and give a second chance? I'm always interested. Do you remember? No, it didn't. Sometimes they will. So down, strong side, room to targets. There's your close below. That did go down. And then you add it on at the HVA. Use the HVA for entry. All right. And it just didn't work out. All right, so we're going to talk about one thing, Trina. And this isn't a deal breaker. It had already been to your target. I pay attention to this. I don't have a rule because if I've got room back to it, these charts are so slow, but I will pay attention to it. And one of the things that I'll do, Trina, just in my own personal, when I'm watching the markets, so down here at 32, when it hit that area, look at the reaction. You are odds favorable momentum up, right? And I think Wayne does. He'll let those small triggers roll. And when they rolled, there's your close below as they're rolling. Right where you got stopped out, the exact same bar. That's your entry at 42.50. And it does go down a couple $100 before it changes direction. But I think that little patience piece, and guys, this is kind of taking a very basic entry on simulator, take them all, right? And then with a little bit of study, there's little modifications. And when it's already been to its target, I hate to fight odds favorable momentum because what it means is that your 1 minute chart, your fast chart, is having a pretty serious reaction from that large chart area. Does that make sense? And when you're on simulator, take them all, annotate them up, post them in the room. We will talk about all of it, I promise. Good stuff. All right, Papa. Momentum was trending down, waiting for price to close below blue fibs. The small triggers pivot to the long. Small chart ended up going long in a strong way. I can't tell if there was an opportunity prior to the small chart taking off to the long, so I did nothing. You did not miss an opportunity, Papa. The triggers were down. That was your trend trade short, but it didn't have a lot of room. But from 700 down to 84, there was about $320 worth of room before you hit support. There it is again. And then support held. There wasn't a long trade though, not yet. That was just a huge reaction off of support. Does that make sense? And then there's kind of something that goes with what we just talked about, right? When you get that reaction off of support, when it's odds favorable up, yeah, nothing to do. Do you see the trend trade though? And I know that you're biased to long trades, so you probably weren't even looking for it. But that was your trend trade short. It's a pretty big bar, but it still went right to where the market said it would go. It was most likely to go. Good stuff. Good picture. And I just closed out all of Wayne's pictures. Awesome. It's hard to make that mental adjustment, I think. If you're a long trader It seems so counterintuitive to go short. And I'm going to be honest with you guys. When I first started, and my brother's like, yeah, sell the market, I kept saying, how do you sell something that you don't own? And I couldn't wrap my head around the idea that you can go short like that and get paid on the way down when your large chart says down with momentum and room to trouble. Pretty cool, right, Boaz? And since it's not areas inside of triggers, he lets it start down off that area and then just follows it down. And it took me forever to come to terms with that. How do you sell something that you don't own? Guys, this is the magic of futures. Chris, my nephew, explained it to me. He said, right here, you're borrowing $100 for an investment, and your investment gets paid at a lower price. At which point you're just giving that money back or something. I don't know. It made sense when he did it. It was pretty smart. Great trade, Boaz. Great patience on the entry because it's on the wrong side of the triggers, letting that market start back in the direction of your trade. Good job. All right. Direction is up. Strong side. Pull back to the area. Close above. Look at that. It went right to trouble, didn't it, Phil? So what's the reaction time? From 30 to 37, that's $140. You're in at 35. You had 2 ticks, or you had 2 points. You had $40 from your entry to get to trouble. Would you agree? Little tight, isn't it? It's a little tight. That's why reaction time, because it did exactly what it said it was going to do. It went up from support with a close on the correct side of the triggers. It just didn't have anywhere to go. Just didn't have anywhere to go. And this is kind of the same lesson, right? It had already been to its target, and now it is screaming down from its target. It gave you the blip and did get you on the full stop. 22.35. I mean, your stop makes sense, man. It's a good look. It just didn't have anywhere to go. Get rid of this zone. Let it run all the way up to 43, right? Give it 160. Give it 260. Then it becomes a manageable trade. But it's a great read. Everything is spot on. Just that damn rule number 2. How much is enough? You've got to answer that question for yourself. Not a legit, well, I mean, it's clear. Use the 21 range triggers to show strong down 2. Right on, Boaz. You guys can use more charts, but you don't need them. And I think this is it. If it's black and white, Phil, so the entry, it looks like, was about 31. You got in 4 points later. Did you hesitate, or was it just that fast? A little bit of both. So if it's tight and you hesitate, you know, that 3 points is $60. That's $100. Maybe you had time to get to break even. When I'm waiting for a trade to set up, and I don't know if you guys do this. Maybe you do. Maybe you don't. When I'm waiting for my trade, I'm hovering over my buy button, right? And if my rules say close on the correct side of the triggers, and guys, the rules aren't met for that, I'm literally right here. And when this gets down to 1, it's like 5, 4, 3, 2, 1, boom. The second it changes, I'm mashing that button because I want the best fill possible, right? I want the absolute best fill possible. So practice that on simulator. Practice getting into the market really quick. Not anticipating, But get that reaction time up. Be like a Formula One driver. Be good stuff. Man, that's all the pictures, y'all. Good job. So let's do our read. Triggers are down for now. Absolutely nowhere to go. No trade. How easy was that? Down, no room. Psh, who cares? Don't even want to look at the small chart. S&P, trend is down. Don't have momentum. Price reaches an area. Triggers haven't broken. Don't have a clear path. Will you guys give me a Y in the room if you see that I don't have rules met for a trend trade? Because it's not the money you make. It's the money you don't lose. I firmly believe that. And I'm going to show you what I mean. A lot of opportunities to take unnecessary losses today. Guys, they're trying to figure out what they want to do. If you trade it into resistance, unnecessary loss. If you trade it into support, unnecessary loss. If you traded without the advantage of momentum, unnecessary loss. If you lost this trade, guess what? Good loss. Only 2 triggers through. Unnecessary, unnecessary, unnecessary. Over and over. Sometimes it's not about what you do, but rather it's about what you don't do. And guys, you've got the golden goose right now. You've got the keys to the kingdom. You've got the greatest software ever, the most simple approach. And all you need to do now is learn how to use it. That's what I'm here for, is to teach you how to use it. And I did have a question sent to me, and I want to let you guys know. If you own Nexgen software, you can get the TradingView indicators. There is no additional purchase for it. You will have to get TradingView. Nexgen doesn't provide TradingView. But the indicators, you've already paid for the T3 indicators. You own the T3 indicators. They are made available to you if you do get TradingView, Sergio. Just wanted to answer that one. So I've got 2 markets and no rules met. What am I supposed to do? I don't know. You guys want to see what I do when rules aren't met? Want me to let you into my world a little bit? When I don't have rules met, I do this. Gosh, crude oil's been a mess. I take a big picture and I do this. I draw an arrow and I start reinforcing rules. Price reached an area, triggers below, no trades in the area. And I want you to see something. That fits here. Oops, where's my stamps? That fit here. And that fit there and there and there and there. It worked out there as well as there and there and there. And when I share this with you guys, what I'm really hoping is that you begin to say to yourself, wow, those areas really do have the ability to stop the market. No matter how much momentum's in the market, no matter what my opinion is, rule number 2 is going to keep me out of a lot of trouble. That's what I'm hoping that you're seeing from this. And you're not hearing, hey, you can't take that trade. You can't do that. Guys, I'm not the trade police. I will never tell you when to enter or exit the market. That's not my job. That is, if you want someone to do that, go get married and let her learn the software. There's your first pullback to the area inside of triggers, and then fib update killed it. Momentum tends to break areas. Not always, but it can, right? Weak triggers, reverse from the middle of nowhere. The exact language I used to teach every day, it shows up live. each and every day. So if these are down and there's nowhere to go, I want to swear a lot today. I don't know why. Large chart has nowhere to go. Stop looking at this small chart, hoping to make a miracle. That's my trading plan. Large chart has nowhere to go. Stop looking for an entry. But it could. Well, that zone didn't give it up there, or there, or there, or there, or there, or there. Are you so egotistical that you think that the 8th time is going to be the time it breaks for you? I don't know. Maybe I am. I might be. There's a good chance I am. I'm a little bit of an egomaniac. But doesn't it make sense to just let it break? Doesn't it make sense to sit still for a minute to remind yourself, hey, the futures markets trade billions. My plan is better than this. My indicators give me so much information. I don't ever have to guess. I just have to wait for those stupid rules to be met. The rules aren't stupid. They're smarter than me. But look, somebody's making decisions, right? What's the decision going to be? I don't know. You found that the 15-minute has the gap theory too. When a big gap created between the price and the triggers, if the bar is up, the next bar down, for example. So like right here, price returns to the moving average, Boaz, very often. A little more advanced, right? But look at it. If you pull it up, price pulls away and it finds its way back, right? Price pulls away and it finds its way back. And price pulls away and it finds its way back. It happens all the time. The challenge is just how slow this chart is. So if you only waited for the pullbacks to the triggers, you'd be waiting a long time. But you can see how often it happens. See if we can find a gap. There's a good one right there. Look at that. They're way up here, Boaz. Look how far away they pulled and snapped all the way back to them. That's pretty cool. Thank you for that. And guys, you'll teach me. When you start getting in your groove, guys, you'll start seeing more. You'll start recognizing patterns. There it is. It didn't break. You'll start recognizing patterns that create more opportunity, that give more options for trading. And the question that I always ask my brother, because we read indicators exactly the same. He taught me. I see what he sees. I don't see it as fast. Do you need every move in the market to be a successful day trader? Do you need every up? Do you need every down? Do you need every tick? Do you have to be the first one in? Do you have to be the last one out? Do you have to hope areas break? Or is there a way? Is there a way to make enough with the fewest moving parts? And if you've never studied the trend trades, you may not have the answer to that question. But if you have studied the trend trades, if you've really done the work to prove that this wins more than it loses, do I have any NinjaTrader users that don't think you could take the basic trend trade concept and build an empire? Are there any TradingView users that don't think you can take this very basic concept and find a way to make enough? I believe you can. I firmly believe you can. It held again. I guess it didn't know that I'm a big deal. Which means that the termination condition on the S&P is also probably trying to hold. Weak triggers. Now the path is clear, but I don't have momentum. I did even have areas inside of triggers, 2 out of 3. Some of you will take this trade. But without momentum, what's going to push it down? I don't know. Guys, what would you like to talk about? We're at the point of the day where I can't trade the KISS plan because the KISS plan rules aren't met. I've already saturated my brain with some pictures. Let's see how many pictures I've taken just today. I love doing this. So today's the 30th. 1, 2, 3, 27, 36. All right, so I'm 40 pictures deep today already. 40 pictures. Entries. I want to show you guys how to get to where you want to be if you really want to get there. Starting on the 30th. I've got pictures of entries. I've got pictures of exits. I've got pictures of the large chart. I've got helping people. I've got defining broken areas. I've got feedback. I've got examples. I've got a fight with my brother. I've got a lesson for me. I've got waiting for an area. Got trading into areas. Got areas holding 15 minute. Guys, the more pictures you take, the quicker you're going to get to where you want to be. The more pictures you take, the faster you're going to get to where you want to be. The more you're going to see. That recognition creates repetition. I'm not going to sit here and talk incessantly, though. So I'm going to mute. If you have a question, ask it. If you have a picture, post it. I'm going to stop YouTube because I'm not going to make them sit in silence.